I recommend you just invest in an index fund which tracks the whole stock market and you don't have to worry about it. But some people invest in actively managed funds. Apparently, according to Warren Buffett, I haven't read the research on this firsthand myself, but what Warren Buffett says and what a lot of advice on this industry is that the funds that do well 1 year, like let's say Chris's fund returns 20%. So my million goes to 1.2 million, whereas the S&P 500, the index market, only returned 10%. So if I was average Joe investing in the index fund, I'd make 10%. But if I gave my money to you, Chris, I'd make 20%. But there's no guarantee that the next year, your fund is also making 20%. And there's also no guarantee that in year 3, your fund is still doing well. And it turns out that there are very few funds, if any, that can actually just beat the market overall, which is what this bet was that Warren Buffett did with all these hedge fund managers, and he ended up winning it.
There is, I think of savings in tiers. The first tier is to secure your well-being. And then after you have that taken care of, then you can go to the next level, take more risk, and so on. That well-being, that purchasing power, has to be viewed in terms of inflation-adjusted dollars. You know, if you're holding a debt instrument and, a cash-paying instrument, and it gives you a 2% interest, and you have a 5 or 6% inflation, you lose money at 3% a year. So you have to look at that in real dollars. And you have to hold that portfolio in a way that is balanced to any kind of economic environment.
Don't worry about it. Put money into, if you're in the UK, into a stocks and shares ISA, which is a savings account, or in America, your Roth IRA or 401k. And if you can invest money, invest it into a stock market index fund. Basically what that means is that you are, instead of buying one company like Apple or Microsoft or Tesla or Google, you're buying a stake in the top 500 companies in America, which would just so happen, like if you put 100 quid in something called the S&P 500, £3 would go to Apple and you'd own £3 of Apple. £2, you'd own £2 of Alphabet A and B. So Google, you'd own £2 of Microsoft, £2 of Amazon, and so on. And that means you can invest in the stock market without worrying about trying to cherry pick individual stocks, which doesn't work for anyone unless you're like a very, very, very professional hedge fund manager. And even then, for those guys, picking stocks doesn't really work. So I think it does help to have a first principles understanding of what the stock market is and how that kind of stuff works. Basically, money sitting on its own reduces its value over time. And therefore, if you have money, you want it to ideally increase its value over time. And one way you can do that, you can do it in real estate, or you can do it by buying and investing in stocks and shares. So you own a percentage of a company. If you do what I recommend, and what Warren Buffett and Charlie Munger recommends, I recommend you just invest in an index fund which tracks the whole stock market, and you don't have to worry about it. But some people invest in actively managed funds. So that's basically, I would give you some money. I'd say, Chris, here is £1 million. I want you to grow my £1 million. You would say, oh shit, Ali's giving me £1 million. I need to grow it. But I need to do something other than just invest in the fund, in the index fund, right? Because I need to try and beat the market. That's what beating the market means. And so you think, you know what? I think Tesla's going to do well. I think Netflix is going to do well. I think Pets.com is going to do well. And I think, I don't know, Febreze is going to do well. I'm going to put $250,000 of Ali's money into those things. And I'm really going to hope that it outperforms what it would have done had I put it into just the top 500 companies in the US without thinking about it. And it apparently, according to Warren Buffett, I haven't read the research on this firsthand myself, but what Warren Buffett says and what a lot of advice on this industry is that the funds that do well 1 year, like let's say Chris's fund returns 20%. So my million goes to 1.2 million, whereas the S&P 500, the index market, only returned 10%. I think there are some funds in the world, like especially the ones that invest in like early stage startups and things, where you probably do beat the market, but normal people don't have access to those. You have to be like ridiculously rich to be able to invest in those sorts of funds that do that kind of thing, is my understanding. Therefore, most people should just invest in the S&P 500 or a broad stock market index fund.
Like if you know that growth is going to be faster than expected and inflation is going to be higher than expected, you know that bonds are going to go down. And vice versa. So the way I give that as an example, so the way I look at it is there are those two big influences, and then they can, so I have 4 environments, and each one of them can go up or down. So there are 4 quadrants that I think of, rising growth, falling growth, rising inflation, and falling inflation. And I want to have a portfolio that will be 25% of my risk in each one of those so that I don't have any bias. And so I pick the assets that are going to do well in each of those 4 quadrants, and I hold them in a balanced way. And I tested that, going back actually to 1900 and so on, and you'll actually increase your buying power. And so that's the kind of thing that I think in the beginning. Then you have to also make provision for, taxes to some extent. So I say, whatever that amount of money is, I want twice as that. So in case it goes in half, and I want to build a portfolio that looks like that for, X number of years that I have that, and that's the safe savings. And then when I go beyond that, then I'll take more risk. But I think that being safe, particularly in this kind of an environment, is important. And I would take a perspective of how to do that that's like the one I'm just describing. So there's these 4 quadrants: growth and inflation. If growth is less than expected and inflation's less than expected, you would like to own bonds. Okay, if it's higher than expected, you would not want to own bonds. Okay, if inflation is higher than expected, you would want to own assets such as commodities and gold and inflation index bonds. If growth is faster than expected, particularly if inflation is less than expected, you'd want to own stocks. So you get the idea.
You want to get to a point where you have enough investments that are spinning off capital or growing such that your passive income is greater than your burn. And you can do the math, right? Well, okay, if I'm going to need $120,000 a year and I think I'll get 8% or 6% on that, I need to save $2 million. All right, this is how many years I have to work. I'll assume the market will go up 8% a year. You can kind of do the math around how much you should be saving and putting in to low-cost index funds. So that's the goal. You want to be rich. You want an absence from anxiety. You want to be able to live well without having the obligation. If you decide to keep working, which I would suggest anyone does, it's a choice. And that in itself is like when I sold my company in 2017 and I was finally kind of done, I felt like I exhaled relief for a good 2 years. It was just like, Jesus Christ, now this is all things I wanted.
I get to choose.
Just to digress, one of my role models, a guy named Barry Rosenstein, who started Jana Partners, said there's 3 buckets in life. There's things you have to do. Your biggest investors in town, you have to do it. You get invited on Joe Rogan, and this is the date, the window. You have to get there for that date, right? There's things you want to do. Oh, I'm going to Cannes to the Creativity Festival, or your mates are meeting up for, in New York, all your friends from the UK, right? You want to do that shit. And then there's things you should do. My coworker's kid is having a wedding. I really should go to this. It's South by Southwest. I got invited to a party with all these podcasters. I should go and network. I should. The great thing about having economic security, and Barry taught me, is he said, you can totally delete the should bucket. I no longer do things I should. And it's actually a bit of a point of tension with my partner. But she'll often say, oh, we should do this. They're nice people. And I'm like, I don't want to do this, and I don't need to do this. I should do it, so I'm not doing it. And that is so liberating to just say, okay, there's just some things you have to do. The stuff you want to do, that's easy. But get rid of the should bucket. But the algorithm itself, or the equation itself, is the following. The first is focus, and it goes back to what we said earlier. Find something that you're naturally good at, that you could become in the top 10 or top 1% in an industry that has a 90+% employment rate, and focus on it. I hate side hustles. Side hustle is fine for exploration. If you're not happy with your main hustle and you can't give it up because you need the money, but it's exploratory. And if your side hustles are going on too long, it means you got to change your main hustle. Because I would bet, and I'm fairly confident the research shows this, that the incremental 10 or 20% effort reinvested into your main hustle will provide greater return than the distraction caused by an incremental side hustle. So find something you're good at that you could become great at through focus. And that's your job. Find that thing. It's not easy. The rest is the product of the following. And this is probably the wrong word, but I like the word. I said stoicism. Recognize there's something's out of your control. My company went Chapter 11 in 2008 after Wells Fargo analysts pulled our credit line because they did some equation showing that the market presciently was going into a credit crisis. I can't control that. I can't control that I got, in some ways, a lot of my wealth since 2008 isn't my fault. The market's ripped up. But I can't control my spending. I can recognize that no one's thinking about my shit as much as I'm thinking about my shit. And I don't probably need a BMW at a young age. First thing I did with my first bonus, at Morgan Stanley, I got a $28,000 bonus. I went and bought a $35,000 BMW. And I hung swimming goggles from the rearview mirror, despite the fact I didn't swim, thinking that would, impress women. And I thought about it. I thought, okay, of course, you're not smart enough to do this, but if I had just bought a Hyundai for $12,000 and invested the other 20 in the markets, I think that money would be worth like 3.1 million now. So recognize there are some things within your control, specifically how much you spend, how much you save, being thoughtful about trying to be disciplined about putting some money in low-cost ETFs and index funds. You do have some control. Focus on the things you can control. The next thing is time. One of our species' great flaws is that because for the majority of our time on this planet, we haven't lived past 35, we just can't calibrate time. And strategy answers one question: what can I do that's really hard? That's basically leaning into your advantages. When you're young, you have one advantage: you have time. Most young people at 25 don't really recognize two things. One, they're probably going to be here for another 80 years at this point, if they're 25 right now. And this is the hard part, and you have to ignore your brain because your brain isn't wired this way. It's going to go a hell of a lot faster than you think. It's just like, I look at you and I immediately think, oh, I'm his age. Because I was 30 or whatever the fuck you are, yesterday. Wow, life has gone so slow, said no one ever. And if I could give you a magic box at 25 and said, if you find $1,000 to put in here, in an instant, and it will feel like an instant, in 30 years, you're going to have 12, 16, 24,000. What kind of effort would you make to find that $1,000? Most of my success and my failure is not my fault. And the way you protect against that is diversification. And now, so for example, I don't put more than 3% of my net worth in any one investment. And last week, if you'd asked me what is the best investment you had that has the most potential to be a 10Xer, I would have said it's this company. I invested in this healthcare company that does preventive medicine through text-based messaging, selling into the enterprise. Baller CEO, tier 1 VC, huge hitters, investors. Had to elbow my way in to get in. What a thrill I got to invest. Went out of business last week. Zero, right? My investment goes to zero. But here's the thing, it bummed me out for about an hour because diversification is your Kevlar. Okay, I lost 3% of my net worth. Doesn't mean anything. Whereas in 2008, when I was running, or when my biggest investment was a public e-commerce company called Red Envelope, which was doing really well at the time, when I met with my investment bank, they said, I think I owned 10 million in stock. And I said, well, how much can I borrow against it? And they said, you could probably borrow 3 million. And they said, what are you going to do with it? Buy out? And I'm like, no, I'm going to buy more Red Envelope stock. And Steve Ballmer did the same thing with Microsoft, and it worked out. You should assume you're not Steve Ballmer, because when my company went bankrupt, it meant that I owed $3 million. I went from being worth $10 million to owing $3 million. The tax on my emotional and mental well-being was enormous. And diversification is your Kevlar, because you don't need to be a hero. You don't need to find the needle in the haystack. You can buy the whole haystack. And again, see above, time will go fast. You'll be financially secure. And Kahneman wrote about loss aversion theory. The joy you'll get from being smart enough to pick NVIDIA 2 years ago, which most of us were not, the joy you'll get of like a lack of diversification and the potential upside it offers is a fraction of the pain you will feel when NVIDIA gets cut by 90%. So for your own financial well-being, much less your own mental well-being, embrace diversification. Because now I don't want to say I don't think about my investments. I'm constantly looking for new opportunity. But because I never put more than 3% in any one thing, it's like, give me your best shot. I can take anything. It's a bullet to the chest when it goes to zero. But I got Kevlar. Yeah, it knocks me off my feet. And then I get up and I got a bruise and I'm like, I'm fine. Nothing's ever critical, much less fatal. Whereas before, when I got shot in the chest in 2000 with the dot bomb explosion or implosion and the great financial recession in 2008, I almost never could get up again. I mean, I came very close to just never getting up again. So focus, find what you're good at, double down on it, diversification, stoicism, save more than you or spend less than you make so you can save, and appreciate just how powerful time and compound interest is. And the way I would wrap it up is, I know how to get you rich. That's the good news. The bad news is slowly. And then it's all wrapped in, and I didn't know how to put this into equation, but I call wealth a full person project. And that is, there's a myth that really wealthy people crawled over other people to get there, that they're billionaires lighting their cigars with $100 bills. That's bullshit. The majority of self-made people are actually good people. They're high character. And the reason why is, if you want to be really wealthy, you need to collect allies along the way. People have to want to put you in a room of opportunities, even when you're not physically in the room. They want to give you the benefit of the doubt. They want to go easy on you when you fuck up. They want to include you in deals. They want to come to work with you. They want to present opportunities to you. And the only way that's going to happen is if you show generosity and character. So, like I said, greatness and wealth is in the agency of others.